The odds of that, according to the CME's FedWatch tool, are 36% that there will be a rate cut of 0.5%. And that would really move gold. That would be a catalyst that would drive gold to higher pricing. The dollar's in a very precarious position. And of course, a lower dollar benefits gold, obviously. Yeah. There's a 100% correlation. So if we get continued dollar weakness, that's another level, another layer that can move gold back near the record highs that we saw last week.
The precious metals market has experienced a notable event as gold prices temporarily pause following their recent record-breaking surge. Traders and investors are now anticipating the next major catalyst that could push the yellow metal to even greater heights. Gary Wagner, a technical market analyst with 25 years of experience, discusses gold's resilience as it continues to hold above $2,500, despite ongoing market volatility. Wagner examines the impact of recent dollar movements and the potential influence of upcoming Fed rate cuts on the gold market. He notes that September's economic data will be crucial in shaping market trends. According to the CME's FedWatch tool, there's a 36% chance of a significant rate cut, which Wagner believes could serve as a powerful catalyst for driving gold prices higher in the coming weeks. Investors should go for gold, as the precious metals' stellar run isn't over, Goldman Sachs analysts said in a research note. Currently, the CME's FedWatch tool indicates a 100% probability of a rate cut in September, with a 63% chance of a 25 basis point reduction and a 37% likelihood of a more substantial 50 basis point cut. If the Fed does proceed with a 0.5% cut, Wagner believes it would provide gold with tremendous support and could push prices into the $2,570 to $2,580 range or even higher. Conversely, if the Fed doesn't cut rates in September, Wagner warns it could send gold into a tailspin, though he considers this scenario highly unlikely. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
The interesting thing that we are seeing in gold is the fact that although gold traded under pressure this morning, and I'm referring to December futures above 2,500, it seems as though every time it's gotten close to that kind of key psychological level, I think the low today was 2506, traders come in and buy the dip. They look at that as an opportunity rather than fading the market and taking it lower. And that to me shows that gold has been resilient. And it's resilient for a couple of reasons. The primary reason is the floodgates have opened up, so to speak, with Powell's comments at Jackson Hole just a few weeks ago, in which he said that it's time for a policy change. So he is signaling that they're going to cut rates. Although he hasn't really talked about a timeline, the inferences by almost across the board in terms of analysts is that September will have a rate cut. And the question is, how deep will that rate cut be? And that's where the jobs report and specifically the unemployment numbers are going to come in. Because if the Fed sees some weakness in the labor market, that would give them the incentive to do what we call a jumbo rate cut, a rate cut of 0.5%. And the odds of that, according to the CME's FedWatch tool, are 36% that there will be a rate cut of 0.5%. And that would really move gold. That would be a catalyst that would drive gold to higher pricing. For the most part, a 0.25% rate cut is currently baked into current pricing, which means that, and I think that the probability are really, really low that they wouldn't cut rates in September, but if they didn't, that would put gold into a tailspin. I don't think that's going to happen. In fact, I'm certain, at least in my mind, it will not. And the question is whether or not they cut rates by 0.5%, because that, for the most part, hasn't been worked into current pricing. And that would provide gold a price boost, tremendous support, and take it, I think, as high as maybe Well, the recent high last week was about 25.60, and we just pulled the chart up, and you can see that right here, these tops that came in. That's the highest record close in history. So when we look at it that way, to get back there and above would be 25.60, 70, 80. We could see numbers going into that area if the Fed cuts rates by 0.5%.
Spot gold has soared by 21% this year, consistently hitting new records and reaching an all-time high of $2,531.60 per ounce on August 20th. In response, the Wall Street Bank has adjusted its gold price target to $2,700 by early 2025, extending its previous end 2024 forecast due to the price-sensitive market in China. Gary Wagner remains skeptical of gold reaching $3,000, despite increasing analyst predictions, stating that the current data doesn't support this. Instead, he has set a more realistic target of $2,700 by the first quarter of next year, a forecast he revised upward a few months ago. However, he acknowledges that market conditions could change. Furthermore, the dollar edged down on Monday, but remained within striking distance of its highest level in almost 2 weeks, as investors' focus moved to a U.S. jobs report due at the end of this week. Purchases by central banks, which hit a record in the first quarter of 2024, have been one of the biggest drivers of the precious metals' rise this year. B of A analysts estimate gold has now surpassed the euro to become the world's largest reserve asset, second only to the U.S. dollar. Wagner emphasizes the strong correlation between a weaker dollar and higher gold prices, suggesting that ongoing dollar weakness could add another layer of support for gold's upward momentum. Now, let's redirect our attention to a video.
That more and more analysts believe that that is possible. I'm still not in the camp that believes it's going to 3,000. I would love to see that, but the data does not support it. And so, yeah, I've been looking for 2,700 by first quarter next year for about the last month to 2 months. Once I revised my forecast upwardly back a couple of months ago. And yeah, we did talk about that a few weeks ago. And I still think that's a very viable target. Of course, anything can happen. That's a lot of time in between the first quarter next year and this last quarter upcoming. So we'll have to see. But I think those are realistic numbers. First of all, this is the dollar index. It is a longer-term chart in that every candle represents 1 week in trading. We need that to pack this much data in. And as you can see, late last week, we had the dollar index go just around 100.50. And this 100 is key because we haven't seen that price point since July. But if we look at it on a technical basis, we have to go back to really April of 2020, really 2420, 2020 is the last time we really saw this become a top here. And the interesting thing about technical analysis, support and resistance is they're part and parcel of the same thing. So here it was a point of resistance. And when it blew that out, and this is really April of 2022, it took it all the way up to really 114 on intraday highs. When it came back down in July of 23, it actually touched almost near 100. And then we've been range bound between 106 and 100. And so we retested that. And last week it kind of popped off of that. And what will be interesting is whether or not the dollar can build some steam and move back up, or if it tests this area, because if we get a hard break, say below 100, on a technical basis, there is no support that really comes in at all till around 98. But that was years ago, 4 years ago. So the dollar's in a very precarious position. And of course, a lower dollar benefits gold, obviously. Yeah. There's 100% correlation. So if we get continued dollar weakness, that's another level, another layer that can move gold back near the record highs that we saw last week. Once the Fed becomes aggressive about cutting rates, the more you cut rates, the more pressure it puts on the US dollar. If treasuries are yielding lower yields, then it makes the dollar go down naturally because it's not as attractive to foreign investors. And so that could pressure the dollar lower.
Commodities are often considered safer investments than stocks during economic turmoil, as they are the essential materials that drive society. However, Goldman Sachs warns that the current environment is risky for most popular commodities, with gold offering the best protection against value loss. The analysts believe that the tripling of central bank purchases since mid-2022, driven by concerns over U.S. financial sanctions and sovereign debt, is a structural trend that will persist. Additionally, imminent Fed rate cuts are expected to attract Western capital back into the gold market, a factor that has been largely absent during the sharp gold rally of the past 2 years. Do you believe gold offers better protection against economic downturns compared to other commodities? Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.